Chapter 10. In Chapter 10, we have to finish something that we have started in 1110, but we never talk about it. And what is that? That's the long-term assets. More specifically, property, plant, equipment, goodwill, and intangible assets. So now we have to go back into 1110. And as you remember, on the asset sides, we have short-term assets and we have a long-term assets. Now, what will be the characteristic of those property, plant, and equipment? Obviously, those are the assets which are held for and used by the business. Those can be tangible. Those are relatively expensive, and they're gonna last for a long period of time, usually several years. At any point can be sold or traded, but keep in mind, that's not part of our operations. Our operation is to generate revenue or to generate sales. Property, plant, and equipment help us to fulfill that purpose, which is the main purpose of the business, to produce products or merchandising to sell them for revenue. So when we sell those property, plant, and equipment, that's not part of the normal operation. That will be something else. So let's go over the objectives first, how we're going to measure that cost and what exactly have to include in the property, plant, and equipment. So property, plant, and equipment, again, this is a long-term assets. What means long-term assets? They're held by the company for the long period of time, which is long period of time, more than 1 year or current operating cycle of the company. So if you remember 1110, I gave you the definition for short-term asset. Short-term asset is the asset that can be used or will be used within 1 year or operating cycle of the company, whichever is longer. Now, the definition for the long-term asset is very simple. Asset which is not short-term is long-term. How are we going to measure those? So once we establish, okay, we get the asset which we're going to use for more than 1 year or current operating cycle. Now, the next question is, how are we going to measure the cost of that asset? So we're going to use the cost principles of the measurement, which is the business must carry asset on the balance sheet at the cost or the amount that pay for the asset. What will be the amount that you paid for the asset? So, for example, imagine you're shopping online and you choose to buy a shoes online. What's the cost of the shoes? Is it the one that you see on the website or the one that you have to pay at the end?
At the end.
At the end. So, that will be the cost of the shoes only. The price that you're going to pay at the end. Is that going to be the listed price for the shoes that you see on the website? Most likely not, right? You see the shoes, they are 99, let's say 59.99. And then you clicking on it and say, oops, there's a shipping. Up, there's a insurance. Up, there's a taxes. So what will be the cost of the shoes or cost of the asset? That will be all the costs which we have to pay in order to bring the asset for the intended purpose, less of all the discounts. So what that means, if you buy shoes, the cost of the shoes are the one going up to the point that the shoes are on your feet and you start walking with them. Up to that point, all the costs which are generating or you have to pay for that shoes will accumulate and become a cost of the shoes. Make sense? So the same principle we're applying for all the assets. which is property, plant, and equipment. Let's go first one, land. First category, property, plant, and equipment is a land. What's the cost of the land? Cost of the land will gonna be purchase price. I'm gonna test you on this. So see, through the assignment, and most likely I'm gonna give you some separate questions on the land and how to calculate the cost of the land. So cost of the land we're gonna include purchase price, brokerage commission, any survey and legal fees, any property taxes in arrears. That means property taxes that hasn't been paid yet. So if you purchase it, you have to pay those taxes. Cost of the grinding and cleaning the land. Cost of demolition and removing the unwanted building. Now the cost of the land is not amortized. That's another thing that you have to remember. And the last thing that you have to remember is the land improvement has nothing to do with the land. Land improvement is a separate asset. It has to be recorded separately. So, in short, imagine this. I'm buying, do you know where, let me think about some building that all of you may know. Do you know what the Sheraton is in downtown? The Wow Centers, Sheraton Wow Centers. There are three buildings. One that looks like a American football. The other two are like a towers, east and west. So imagine this. That's close to Barrard Station. Sorry, not Barrard Station, close to Barrard Bridge in downtown. Or let's say Hyatt Hotel on the Barrard Station. Do you know that? Yes. No? Okay, so what else? What else? What would be some iconic building that everybody would know? Vancouver Library, BC Place. Okay, BC Place. Yes, BC Place. Okay, BC Place. Imagine this. I'm buying BC Place. Now, the only reason that I'm buying BC Place is because of the land. So, why do I need that land for? I need that land to grow potato. Right in the middle of downtown, I want to have a land on which land I want to grow potato. At the end of the day, who's gonna stop me? It's my land. So imagine this. How much will be the cost of the land? Until what point I have to accumulate the cost and say, okay, this is the cost of the land. Remember, I'm buying the land, the BC place, and all the property in the BC place for only one reason. I want to grow potato. So tell me, what will be the cost of the land? Any suggestions, or you're gonna be quiet and you're not gonna say anything? First, purchase price, right? That's out of questions. Second will be the brokerage. I have to pay the broker. Then I'm gonna start demolition. I'm gonna demolish and remove all the garbage which is created by BC Place. I want it out. In the meantime, I might find something valuable in those. When I start demolishing BC Place, I might find some materials that I might sell. So the selling price of that material is going to reduce my cost of the land. So when I'm going to start accumulating the cost? When will be the time that they're gonna stop accumulating the cost? What do you think? No, so technically yes, when the somebody says the land the all the land, all the property is ready, you can start growing your potato. Once somebody says that, that means done. Up to that point, I'm calculating all the costs, deducting all the uh, proceeds that I might get from selling some materials. If I get some discounts here and there, I'm deducting those one. So up to that point, when I'm ready to start planting my potato, up to that point, the cost is, and that become cost of my land. Now, am I gonna amortize the land? No. Why not? Well, because simply the land was there 250 million years ago, is there today, it's gonna be there 250 million years later. So for that reason, no amortization on land. On all the other assets, there's amortization. Mine, what mine? Do you mean mine for some minerals and something like that? Is that what you're saying? Yes. Okay. So that's completely different story now. Again, you going there, let's say you chasing gold. You're not buying the land, obviously. If that's the case, all the company that exploring the any natural resources from the land, they're not buying the land. Government's not gonna let you buy the land, but it's gonna give you that piece of land on concession or some contract for long-term contract, let's say 20 years or 50 years. But not to extract the land from the land is to extract and explore the minerals from the land. Land's still gonna be there. Don't get me wrong here. You can get the minerals, but land is gonna be there. So you're not buying the land because you want to take the land, or you're not renting, or you're not signing the contract with the government for the land to take the land. You're signing the contract because you make the research that there's some valuable minerals. So we're not gonna amortize the land again. We're gonna see later how that works. But that's a good question. So let's keep going now. Let's measure the cost of the land. Purchase price, $500,000. We're gonna add the brokerage commission. We're gonna put the transfer taxes. We're gonna put removal building. We're gonna put the survey fee. And the total cost of all those expenses, I mean those payments, not let's not call it expenses, because after that you're gonna start putting those one in expenses. So the total cost of the land is $546,000. What is the journal entry? Now I have to record it. Well, debit land for $546,000, credit cash. Because you're paying everything, let's say we're paying everything cash. Now, what the students usually doing when they see that type of question? Question has two portions. One portion is you to calculate the cost of the land. Sometimes they get it, sometimes they don't. Well, let's say you get it. You get 546. And after that, they have to do the journal entry to record the land. Do you know what the students doing? They showing this. Debit land, $500,000. Debit brokerage commission expense, transfer tax expense, removal of building expenses, survey fee expenses, paying cash 546. Then my question is, Why do you have to calculate the cost of the land if you expense all those expenses? That doesn't make sense. So when you're calculating the cost of the land, the only reason that you're calculating the cost of the land is you want to see what's the amount that's going to be debited to the land. If I have to expense any of each of those amounts, I'm not going to do this calculation. That's a waste of time, waste of energy. So please don't make that mistakes. So again, you're doing this calculation to find only one thing. How much is the value of the land? How much you pay, sorry, not the value. How much is the cost of the land? And that cost will be your part of your journal entry, debit land, credit cash, in this case. Let's see now land improvement. What's the land improvement? Land improvement, including lighting, signs, fences, paving, sprinkler system, landscaping. All those are separate assets. They have nothing to do with the land. So imagine this. I purchased the PC place, the land is ready, I can start growing my potato. But I want to plant my potato at night because during the day I have lectures. So what I have to put? I have to put lights, lighting everywhere. Is that going to be part of the land? No, that's a land improvement now. I'm going to put a big signs. Don't cross my potato field and don't take my potato. I can put fences. I'm not going to put any pavings, but I can definitely install sprinkler system. Put some irrigation there for my potato. But again, that's not going to be part of the land. That's going to be land improvements. And those land improvements going to be treated separately on the separate account. So the lighting that I'm going to put, so I can plant and after that taking care of my potato at night, that's going to have limited life. That's going to be amortized over the life. The signs I'm not going to put, those going to be amortized. The fences that I'm going to put around my potato land, it's going to have a limited life. Sprinkler system, same thing. But the land itself, it's going to last. So that's the first question. Which of the following asset is never amortized? Obviously. Now let's see the other category of plant is building. Now we have, in general, you have two options here. Either you're going to buy a building which already been built, either you're going to start from scratch. If that's the case, then you have to do construction of the building. For the construction of the building, will be what will be the cost of the building then? Then will be the entire cost to build the building and somebody to tell you that now you can use this building for the purpose that was intended. So if you're building an office building, you're going to start with the architectural fee, with the building permit, with the contractor charges, with the payment of material, labor, overhead, all the things until somebody comes and say, this is the schedule, something that tells you that now you have a letter of occupancy or whatever it is. So now you can actually walk in the premises and start using the building for the intended use, which is office building. When somebody says that, you're calculating all the cost that become cost of the building. Equipment. Equipment can be machinery or can be equipment, can be small. What will be the cost of that? Again, everything which is needed for that equipment or that machinery to be used for the purpose for which you're buying it. So that can be purchase price. If there's any discount, you have to deduct discount. Transportation costs, shipping, insurance while I was on shipping, or while I was on transit. Provincial taxes. Why provincial taxes? Because the provincial taxes, government's not going to give you back. We're going to see next time about the GST, but for the GST you can claim input tax credit. For the provincial taxes, you cannot claim anything. You just have to pay it. So that's non-refundable taxes. Purchase commissions. If you pay purchase commissions, that will be part of the cost of the machinery. Installation costs. Sometimes you have this major equipment which need a special installation. Anything related to the installation is going to be related to the cost of the equipment or machinery. Testing before you start using, that's also cost of the machinery. So until the people who install the machine tell you, now you can use the machine for the intended purposes, until that point, you're calculating all the costs. And whatever you pay, that becomes a cost of the machinery. Simple example will be, you're buying a, let's say, dishwasher from Home Depot. What will be the cost of the dishwasher? What do you think? So let's start with the first one. First, you're going to get the purchase price. If you get some discount will be deducted. Then, yes, delivery, taxes, installation cost, testing. Because once people install the dishwasher, they have to test it. Insurance, purchase commission, installation, and testing cost, everything. And once the person who installing it connected to wire, connected to the sink, connected to everywhere, testing it, and he says, okay, the dishwasher is installed, the tests are done, everything is in order. Please sign this document. Once you sign document that everything is done, you're accepting that this machine has been installed, has been tested. Now you can use it for washing your dishes. One copy for you, one copy for him. And that concludes the purchase of the dishwasher. Whatever you pay up to that point become the cost of the dishwasher. Now, another category will be the furnitures and fixtures. Computer also will be reported as equipment. So, leasehold improvements. Most of the time, corporations or companies, they leasing a property. Now, do you understand the difference between rent and lease? Is the rent lease or is the lease rent? What do you think? Any suggestions? No, it's not. And you're correct. Rent is short term, lease is long term. So once you sign the lease, usually you're getting premises which might not be in the exact condition that you want to use it for. So what you have to do? You have to do the major renovation on the premises once you sign the lease agreement, let's say for 5 years. Then you have to adjust the space for your needs, the way you intend to use that space. So you might have to install some equipment, you have to do some painting, you have to change the wall, you have to do some calibration on the HVAC system in order to meet your needs. All this will be cost. And those costs will be related to the leasehold improvements. So you're calculating those costs and you're recording as a separate asset. And those will gonna be considered asset. Construction in progress. Construction in progress, that will be asset, same as a capital lease. Capital lease is an arrangement where the capital assets are acquired through the lease contract. Now, pay attention to the people who's going to continue with the accounting. Pay attention to the capital lease and what the capital lease is, because here in this part of the accounting, we're talking about capital lease, which never going to talk when you move to the International Financial Reporting Standards. On that, you're going to use different terms. So capital lease is referred only to the accounting standard for the private enterprises, which all these principles of accounting 1 and 2, all the rules that apply are rules for the standards applied here are accounting standard for the private enterprises only. So the capital lease is arrangement where the capital assets are acquired through the lease contract. Obviously, by the end of the lease agreement, the lessee will have to use the asset during the substantially all of useful life. Capital lease, those are reported as asset in the same way as a purchase asset. And those are different from operating lease. In the accounting standard for the private enterprises, we have two types of leases. One is capital lease, the other one is operating lease. Now, what's going to happen if we buy a lump sum assets? That's called also basket purchase of the assets. So here the example is, let me copy this example and I'll move it to the Excel spreadsheet so we can work together so you can get the idea of this basket purchase of the asset. Just give me a second to modify a little bit and I'm gonna bring it on the screen. Okay, almost there. Some modification and now I can start sharing my screen. Okay, so we purchase land and building all together. And we paid $540,000 for the land in the building. Now the question is, how much of this $540,000 is related to the land and how much is related to the building? How much of this I should allocate to the land and how much I should allocate to the building? Simple thing, what we have to do. Whatever we paid here as a dollar amount, as a percentage, is 100%, correct? That's how much we pay for the land and for the building. Now the question is, how much of this 100% belongs to the land and how much belongs to the building? Simple way to do it is go and check the market value. We check the market value and the market value of the land is $200,000. Well, let's change the numbers. Let's say the market value of the land is $300,000 and the market value of the building is $420,000. Therefore, random numbers which are completely different of what they're suggesting, right? So how much is the total market value? $720,000, which I already paid for those. I already bought them. Land in the building, I already bought them. I paid $440,000. Now try to figure out again what's related, how much to from those $540,000 to put for the land and how much to put for the building. Approach that we're taking, we chasing the market value of the land in the building. We found the market value. We're calculating the total value is 720. And we say, okay, we make a great deal. We paying less, $720,000. We paid, so we paid 540,000 for something that market value 720. So we made great deal. We actually pay $180,000 below the market price. Awesome, great. Now we have to make journal entry to record our purchase. So what I'm going to do, I'm going to use the proportional method. What is the proportional method? I already know that $540,000 represents 100%. Well, same thing with the total market value. Also represents 100%. I know those values because I did the research. I know those values are true. So what do I have to do? I have to find what's the value of the percentage of the land out of the total and what's the percentage of the building out of the total. So what I'm going to do, 300,000 divided by 720, and that will be the percentage here, 42%. If you have to be explicit and show the numbers, 4167 is the exact percentage. Then I have to get what's the value of the building out of the total value of the assets that I get. Obviously, that will be the difference between 100 and the value of the land. So those two together, they have to give me 100%, which they give me 100%. So what's the next thing that I have to do? Well, once I have those percentage, I'm going to get those percentage here, copy. I'm going to paste them here as a dollar amount, as a value amount. And I have to find out now how much is 41.67% out of 540 and how much is the 58.33% out of 540 and applying the same percentages. So that one time this percentage and this will be this amount time the percentage. So what will be my journal entry? My journal entry will be very simple. Debit land and the value that I'm going to assign to the land is the 225,000. Debit building. Let's format those pages here. That will be 350,000, and then I'm gonna have here a credit cash, and the cash will be for the amount of $540,000, and my job is done. I did my journal entry. Make sense? So if you have a purchase of the basket of 1 or 2 or 3 or 4 or 5 assets, what you have to do, get the market value, assign the percentage, see how much you paid, use the same percentage that you calculated to the market value, and make the journal entry. Let's go back to slides and continue with the slides now. And here, obviously, since I changed the numbers, we're going to come up with different percentages here, but at the end of the day, you're chasing was the percentage of the land out of the total, building out of the total, applying those percentages to the $540,000 and getting the actual value that you're going to assign to the land and to the building based on the cash that you paid, not based on the market value, based on the cash. Why? Because we're recording the assets at cost. So let's do this question and to show me that you know what you're doing. So here we paid, let's get this question, copy and let's move it to the Excel spreadsheet and let's see if we can solve this problem on the Excel. Let's get a new worksheet here and post the question. So this is our question. So what we purchase? We purchase two things. We purchase equipment and we purchase building. Let me make it bigger so you can see it. We purchase those two assets. What's the value that we purchase? Total we paid $184,000. Now, we don't know how much to assign to each of those. That will be the cost that we want to assign to those ones. But we already find out that the market value for the equipment is $100,000 and for the building is $150,000. So did we get a good deal here? Looks like it. Compared to the market value, we're paying less. We're paying only $184,000. So what's the amount that percentage of the amount that we paid total is 100%. What's the percentage of the total market value? Same 100%. And then we start expressing the percentages. So the question is, how much we should debit? What will be the cost here for the equipment? We have to do debit equipment. Debit building. What's the value for the equipment? Credit, cash, that's obviously how much we paid. What will be your suggestion? You're saying 73,600. If you assign 73,600, how much is going to be left for the building? Only 4,000. Is that true? What's the percentage here? So we have our percentages. What we have to do, flip it here and work with those percentages. And you're right. Questions with this question? Can I go the opposite way? Can I, if I'm paying $184,000, but later on I found out that market value here is 50,000 and the market value of the building is only 70,000. Can the question go that direction? Or let's get something more, 80,000. What do you think? Trying to find something which is a round number. Can I go this direction? Why not? But for academic purposes, we can go either way. The whole point is you to understand the logic. What will be the market value doesn't matter. But you're going to use the market value to come up with the percentages. That's the whole point here. That's why we're using this market value to come up with the percentage to see how much to assign for the equipment, how much to assign to the building. That's the whole point. Okay, let's go back to the slides and continue with the slides. Next thing that we have to do is we have to establish what is repair and what is the betterment. Now, repair is a part of the normal maintenance of the asset. We're doing the repair for only one purpose, so the asset can fulfill the person for which the asset was bought in the first place. What is the betterment then? Well, the betterment is something that adding value to the asset to improve the asset use, either to increase the asset useful life, either to become the asset more efficient. How can we treat betterments versus repairs? Well, betterments will be part of the asset and it's going to be debited to the asset and it's going to increase the value of the asset. Where the betterment will be purely expense. The repair will be purely expense. Why? Because it's just maintaining our assets. Question for you. I bought a car. I have to change my brakes. What's that for me? Is it betterment or repair? Repair. You're correct. Why is repair? Now justify your answer. Why is repair? All right. So the other thing, another question. Let's say I bought Austin Mini Cooper. And I'm not happy with the engine, doesn't perform very well. So I changed the engine. I put the engine of Porsche on my Austin Mini Cooper. What's that for me? Repair or betterment? Okay. So you get the idea. Good. Now let's go to the ethical problem. The ethical problem is you as an accountant always have to make a decision. Is it a betterment or is it repair? What's the difference? The difference is in the first case, you have to add it to the asset. If you add it to the asset, you're going to hold it on the balance sheet. If it's repair, you can purely expense it. What's going to happen when you expense it? It's going to reduce your income, but also it's going to reduce your taxes. So what shall we do? That's where you're going to be, and that's where the position will be, and you have to make that judgment call sometimes. Is it going to be pure expense, or is they going to put it on the balance sheet? Now, what's happened with in 2000? 2000, there's a company which called WorldCom. Probably some of you weren't born on that year, but anyway, it happened. 2000, year 2000. Year 2000, there was something that was building up 1998, 1999. That's so this company, what they're doing is very simple. Instead of expensing something, they decide to capitalize it. What happened? Well, they're not showing expenses. If you're not showing expenses, where is your income? Your income going up. Well, the income goes up. What else goes up? Earnings per share. And you're showing nice, juicy earnings per share. What's happened with the investors? Investors wants more share. Why? Because you generate income. Your earnings per share is going up. Until 2000, when these people came and say, oops, we make a mistake. There was this cost which we capitalize it, which actually is not supposed to be capitalized. It had to be expensed. So we made the wrong choice. Now we have to make a correction on our financial statements. And they did actually, in fact, make the correction in their financial statements. So they moved the asset into the expenses in 2000, year 2000. The only problem was that the assets that they moved was for the value more than $2 billion. You can imagine what's happened with the price per share. That's the implication of the wrong judgment, or maybe it was the right judgment, who knows. Now, let's go something else. So we have this asset. We're sitting on the balance sheet now. We're capitalizing the cost. Everything that we need to put this asset for its intended use. We're calculating the cost, we're recording it, so now we have this asset sitting on the balance sheet. What we're going to do next? Are we going to use the asset for the main operation of the company? Let's say you're buying a laptop. The question is, are you going to use the laptop now? Well, that's the whole idea, right? Otherwise, why would I buy the asset? I need the asset in order to operate. So, okay, so you're operating, you're generating income. So if you don't transfer the cost of that asset, which you're using to generate income, into the expenses, your income is going to be too high. And you're going to show the assets which are brand new sitting on the balance sheet, which in fact that's not true. Why? Because you're already using it to generate income. So you slowly, the whole idea is, okay, you get the asset, but now you have to slowly transfer the cost of that asset into the expenses. The question is how? And that's where the amortization come handy. So amortization, what's the amortization? Amortization is transferring the cost of the property, plant, and equipment into the expense in order to match the revenue that all those assets generating. Now, how we're going to calculate the amortization, that's a different thing. One thing you should know, amortization is not cash outflow. In other words, you cannot buy in the store, you cannot go in the store and buy amortization. Because again, amortization is transferring the cost of something that you already have and you already purchased and you already pay for it into the expenses because you're using it to generate revenue. So basically, you're trying to match the revenue with expenses. Nothing more, nothing less. Amortization can also be called depreciation. And now on the amortization, in order to calculate the amortization, we're going to start using different terms. Now, how long we need to record that amortization? As long as we're using the asset. So we have to prorate the amortization over the useful life of the asset. But there's some complications. So the basic things are amortization will be based on the cost, which we already calculated in the first objective. The total cost of the asset means purchase price minus discount plus the transportation plus installation plus testing, everything. We need to know how much we're gonna use that asset for, estimated useful life, 1 year, 5 years, 10 years, and is there anything residual value? Residual value is what will be the value of the asset at the end of the useful life? Is it gonna be zero? Is it gonna be 1,000? Is it gonna be 500? How much is it gonna be? So let's keep going. So in order to calculate the amortization, we need two things. First thing, we already said, it's a cost. Cost, we're going to calculate it using the previous approach. Second, we have to estimate, or not calculate, estimate useful life. That will be the length of the service period that we expect to use the asset. That can be expressed in years. It can be expressed in units that the asset can produce. It can be expressed in kilometers that the asset can pass. Then we have to calculate what will be the value at the end of the useful life of this asset. Why this is very important? Because that estimated residual value or salvage value will reduce the amortization cost, and we have to consider it. So how much we're going to amortize? Only the amount that we're losing, means the cost that we paid less the residual value, because the residual value is the amount that we can cash that we can get at the end of the useful life. So we don't have to amortize that amount if we get it back cash. So we're only going to amortize the cost less the residual value. And that's how much we're going to transfer into the expenses. We're going to reduce our income. So let's see now. Different assets, different amortizations. First one, land, no amortization. Land improvement, amortization. Building machinery, equipment, furniture, fixtures, amortization. Natural resources. So now it's coming to the point of the natural resources means copper, mining, uh, gold, any precious minerals, oil, natural gas. Well, they all have capacity. For them, you're going to use either amortization, either depletion. If you have, let's say, you're digging in your backyard and suddenly there's oil blinking from the ground. Well, that oil, it's in the bubble, which has a capacity. And that capacity, once you take out all the oil, it's going to become zero. So that amount is going to deplete slowly, slowly, slowly once you start extracting it. That's why we're going to have depletion, not depreciation. On the intangible assets, on the intangible assets, we're going to use only amortization, and the goodwill, that will be impairment loss. So how many methods we're going to have for amortization? We're going to have different methods, depends on what we need it for. First one is the most simple one is the straight line method. Straight line method is the same amount over and over and over and over and over the year of usage. So let's say if I buy assets which cost me $120,000, I'm using it for 10 years, and at the end of the 10th years, I can sell it for 20. Means that I have to amortize only 100,000 over 10 years. If I amortize every year 10,000, after 10 years, I'm going to amortize 100,000. At the end of the 10th year, I'm going to sell the asset for 20, and I cover the cost. Unit of production. What we're going to do is we're going to allocate the cost of the asset over the unit that was produced or the output of kilometers that asset driven over the useful life. How we're going to do this? We're going to see in a few minutes. And the last one is double declining. Double declining, we're going to use amortization amount, which is greater in the beginning of the use of the asset, and slowly, slowly, progressively going to go down. Let's go with one question for you. So yes, depends on what we're using the asset, and depends on how the revenue is generated by the asset and how the value of the asset goes down over the years. That will determine which method we should use. Are we going to use the straight line method? Are we going to use unit of production method? Are you going to use double declining method? But yes, you're right. If the revenue is fairly evenly over the time, we're trying to match to make it the amortization to be fairly evenly over the time, in which the method is to give you that option, and that will be the straight line method. Let's go with the example. I'm going to copy this example, and we're going to start working on this example. I'm going to flip to Excel spreadsheet and going to do all the things on the here on the slides on the Excel spreadsheet. And then we can move back to the slides to repeat everything. Let's go with that Excel spreadsheet, and let me share my screen. Can you guys see my screen? Yes. Okay, let's flip this question here. This is the question with all the information. Once I saw this course is online, I kind of like the idea. Why? Because we can use the Excel spreadsheet uh, all the time. Here in the online environment, the Excel spreadsheet, using it in the classroom, it's not very helpful sometimes, because require everybody, all the students, to have the laptops, everybody to be on the same page, and sometimes the level of Excel of the students is different, so that creates a little bit problems. So we have the cost of the truck. We have the estimated useful life, residual value. We have amortizable cost. We have estimated useful life of the years and units of production. So that's not always going to be the case. So what you're going to see in the questions, you're going to have cost of truck plus the transportation plus this plus this plus this plus this. So you have to come up with the cost. So you always have to come up with the cost. So cost, or you have to come up with assets cost. In this case, assets cost is 65,000. No questions about it. Second thing that you have to come up with is the residual value. What we're going to do with the residual value? We're going to deduct it from the cost. So every time when you see the residual value, that means you have to deduct that amount from the cost. That's not what I wanted. I want something else. That will be -5. So let's do it this way. And after that, once you do this simple calculation, you're going to see how much you have to amortize. So in this case, we have to amortize $60,000, which is given in our question. So we don't have to sweat on that one, but this is the proper way you to calculate it. I want you to get this pattern and get this habit to always to calculate by yourself. So now the question is, I want to amortize. I know how much I have to amortize. I have to amortize $60,000. How? And that's where the methods come handy. First one method we said is the straight line method. What means straight line method? Somebody to tell me what, if somebody tells you straight line method, what that means to you. Same amount year after year after year after year. The question is, over how many years? For that reason, we have to find it. What's the useful life of this particular asset? In other words, for how many years we're going to use it? So once we have the amortizable cost, we need year of usage. How many years? 5 years. So then we go, what we're going to calculate? We're going to calculate amortization, amortizable amount, or amortization per year. And how much will be that amortization per year? In our case, 60,000 divided by 5. 12,000 every year. Can I go one step down? Can I get amortization per month? Yes. Months per year. How many months we have per year? Usually 12. Now, obviously, depends on where you're doing the accounting. They may go up now in the number of months. But as long as you stay on planet Earth, it's going to be 12. So 12,000 divided by 12 months, that's going to give you amortization per month. What was the shortest reporting period? In accounting, what was the shortest reporting period? The period that we have to prepare financial reports. Month. Can I prepare weekly reports? No, a week is not reporting period. So for that reason, we need most of the time we need amortization per month. So once we do this, now we know that how much is per month, how much is per year. Obviously every year every month when we amortizing $1,000, at the end of the 5 years, we're gonna amortize $60,000. So let's prepare this amortization schedule. Amortization schedule. On that amortization schedule, what we're going to have in the beginning, we're going to have years. And first we're going to have year 0, year 1, and keep going until year 5. Always in the beginning, we're going to start with the beginning balance. Then we're going to have amortization expense for the period. Let me see how can I make it. So amortization expense for the period. Then we're going to have total amortization, which will be accumulation every year after year after year. And then we're going to have ending balance. Let's see if that's going to fulfill our purposes. Or total amortization, yes, ending balance. So let's think about it. What will be my starting balance at year, ending balance of year 0 once I purchase this truck? What will be the amount that I have to start with? Obviously, that will be the cost of the asset, right? 65,000. So for that reason, we can actually, we can make here one adjustment. That will be the carrying cost, or the amount that we're going to have on the balance sheet. Carrying cost on the balance sheet. Let's make something different than all the books. So in the first, so let's think about something. How much will be my amortization expense year after year? Do I know that amount? Yes, how much will be? 12,000. How much will be my amortization expense second year? 12,000. Second year. still 12,000. Third year. So if I long this cell here, I can easily drag everything and always going to be 12,000. All the 5 years. How much will be my total amortization expense for the 5 years? Do I know that amount? Before I even start doing my schedule. 60,000. So if I calculate 12 for 12 for 12, total should be 60. Yes, it is 60. So how much will be my total amortization of the fifth year? Obviously, it has to be 60. Because that's that's how much I have to amortize. What will be my carrying cost at the end of year 5, sitting on the balance sheet for me? 5,000. Do I know that amount before you even start doing the calculation, the amortization schedule? Yes. So there's nothing is hidden here. So that cost will be negative of that one to make it 5,000. So what do I have to do? I just have to fill the gaps. So here I'm going to have 65,000. Then let's make it nice with all the zeros. Format this one all the way to the end. Then grab this 2, format all this here, and we're done. So the total amortization, obviously, total accumulated amortization will be exactly the first year. My carrying amount will be whatever it is, minus 12,000. Next year, beginning balance is now it's going to be this amount. And next year, keep going. My total amortization will be first year plus the second year. My carrying balance will be previous year minus the current year amortization. And we're going to keep going. So I have to adjust this formula here to be this amount minus the current year amortization. So once I grab those and just fill the gaps, I'm going to have my amortization schedule. So now on your assignments, you're going to have to prepare amortization schedules. And you have to plug the numbers manually. Don't go crazy. What I suggest you is do what we're doing here in during the lecture. Prepare your amortization schedule separately on the Excel spreadsheet. Then transpond the numbers from the Excel spreadsheet into your assignment in Pearson. Get the job done. Don't start doing this with the calculator and plugging the numbers and typing with fingers, and don't do that. Don't waste your time. You have this beautiful Excel spreadsheet, which this Excel spreadsheet I'm gonna post. It's gonna be available for you on the Blackboard, and you'll be there. Not the Bloodport, Blackboard. So that was the straight line method. Any questions? If you don't have questions, let's move to the next Excel spreadsheet, next worksheet. So that will be straight line method. Let's move to the next one, which will be the unit of production. So for the unit of production, I'm going to get rid of this. I'm going to start from scratch. And unit of production, we need new definition here, which is unit of production method. For the unit of production method, what do we have to do? You have to find out during the useful life of the asset that we just purchased, how many units we can produce? So total units production over the entire useful life. So how many units we can produce? We already have it, 400,000 units. So once I know how many units I can produce, what's the next logical thing to calculate? Amortization per unit. And how much is my amortization per unit? How much I have to amortize? 60,000. Over how many units? 400,000. So what I'm chasing here, amortization per unit. So what will be my numerator? What will be my denominator? Okay, let's get that one divided by 400,000. So my amortization per unit is 15 cents. What that means? That means that every time I produce 1 unit or pass 1 kilometers with my asset, I have to amortize 15 cents. I have to add 15 cents to amortization. Does that make sense? Okay, so I'm gonna go to the slides and I'm gonna get the usage. And grab it and I'm gonna post it right here for you. So the example is the truck was driven 90,000 kilometers year one. Let's get rid of something. Year one. 120,000 kilometers year two. 100,000 kilometers year three. 60,000 kilometers year four. And 30,000 kilometers year five. Question is, can you calculate now the amortization per year? You should be able to, right? So let's go. What do we need? Pretty much the same amortization schedule. Amortization schedule. What we're gonna have? Again, the same years. We're gonna start with year 0, 1, and 2, and all the way to year 5. Too many? 6, 5 years. What's the next thing that I need? Obviously, beginning balance. Then we're gonna have amortization per unit. No, actually, that will be kilometer driven. Those are too big. can we make kilometer driven cost per kilometer or amortization per kilometer total amortization or amortization for the period which period is 1 year. Then we're going to have total amortization. And the last column will be ending balance or carrying amount. Ending balance, or that will be carrying cost. And let's start filling the gaps. See if that's going to fulfill our needs. What's my carrying cost at year 0? Same thing like before. 65,000. That's not going to change. Always going to be 65,000. Let's put this one here. And let's start. Keep working. So my beginning balance year 1 is 65. Kilometer. How many kilometers I drove the truck first year? 90,000. How much per kilometer? 0.15. How much is the amortization for the period? 90 times 15, 13,500. How much my total amortization? Well, same amount. This is the first year. How much our carrying cost? Well, the starting point minus the first year. What's going to happen second year? Keep doing the same. What's our objective? What should be my carrying cost at the end of the year 5? 5,000. Is it possible my cost to be below 5,000? No. So my carrying cost at year 5 has to be 5,000. No more, no less than that. It can be more, but no less than that. Make sense? So how much should be my total amortization once I finish the whole calculation? 60,000. Can you be more? No. Okay, so let's keep going then. The other question for you. How many kilometers I have to drive my truck in order to amortize it to 60,000? Do you want me to repeat the question? How many kilometers I should drive the truck in order to give me $60,000 amortization? 400,000. The question now is, listen carefully. Can I drive the truck more than $400,000? 400,000 kilometers. I mean, listen again. Can I drive the truck more than 400,000 kilometers? Yes, Joanna, the answer is yes. That's why you should go with accounting. But that's not the point. The point is, if I drive it more than 400,000 kilometers, can I record amortization? No. Why? Because I already hit my total amortization. This is a very common mistake, and this is a one check that I always want you to do. So what you have to do is, let's keep going with the chart. Let's prepare the schedule, and I'm going to show you the tricks. Here, let's get the beginning balance 51,500, and then next year, how many kilometers we drove the truck? 120,000, 0.15 per kilometer, and I'm going to drop this formula here, 18,000. My total amortization will be the first year plus the second year, and my carrying cost will be previous year minus current year. And now I can drag those formulas here. I can drag this one. I can drag this one down. I can drag this down. And I can drag this one down. The last thing that left is to plug the numbers, the kilometers, here. So how many kilometers I'm driving it next year? Year 3, 100,000. Year 4, 60,000. Year 3, 30,000. My checkpoint is here 400,000, right? This is the checkpoint. So what do I have to do? After I add all the kilometers, those kilometers should be equal to 400,000. If they're not equal to 400,000, I'm in trouble. Check, right? So once I do that, I'm going to amortize $60,000, and I'm going to have $5,000 sitting and waiting for me at the carry amount so I can sell the asset and get my $5,000. Now, sometimes the questions, what they're going to do is here, instead of 30,000, let's copy this one. I'm going to purposely copy this one, and I'm going to post it here so I can show you where the tricks are in this tab on the unit of production. What they trick you here is sometimes they tells you on year 5, they give you this information, and they say on year 5, you drove the truck 45,000 kilometers. So what you have to do is you do your due diligence. Plug the kilometers first, put here 45,000 kilometers, and see what's the total amount. And once you see that the total kilometer driven are more than the kilometer which are given in the beginning, for which kilometers you're calculating amortization per unit, obviously you're going to take more amortization. Obviously, the carrying amount will be less than the residual value. So what you have to do, once you see that in the question they're using more kilometers, then come here manually. This is your red flag here right away. So come here and manually adjust the number. Instead of 45, look, 30. And good, good job, creator of the question. But I caught you this time. That's what you have to do. Make sense? Again, when you have unit per production, double check. Calculate the numbers. See if those numbers adding up to the number which is given on the question for the total unit produced or kilometer driven. If it's more, actual usage is more than the number of the estimated of product last year adjusted to match the number on which you're making the calculations. Don't go any higher because that's going to change the entire calculation here. That was unit of production. Now the last one that left is double declining. Any questions on the unit of production? Okay, let's go with the next one, which is the double declining method. So for the double declining method, again, I have to delete. Sadly, I have to delete everything. And I have to delete all those information. Boom. And have to change the name here. Instead of unit of production, we're gonna go double declining method. The one thing that I want you to see is the method itself. It says double declining balance method. So we're gonna double decline the balance. Which balance? That's the question now. So how are we gonna come up with the double declining? It's a very simple. First, before we do that, we have to calculate what's the percentage amortization per year. How can I do that? Do I know how many years I'm using the number of years? I'm using the asset. 5 years. That's not dollar amount, that should be purely number. 5 years. So how can I get the percentage? Very easy. You're gonna use this one. The percentage will be equal to 1 divided of the number of the years. Why 1? Because 1 represents 100%. Make sense? So how much will be my percentage per year? It's going to be 1 divided by 5. And it's going to be 20%. What if I use my asset for 6 years? 6 years. Let's put it as a formula because I don't want to plug all the things. That will be 1 and that will be equal here. This one divided by this one. And look here. Not this one here. Let's plug 1, and again that will be 1 divided by 5. What if I use the asset for 6 years now? What will be my percentage? %17 per year. It's gonna be the actual number is gonna be very, very, very 16,666,667. But if I use it for 8 years, it will be 12.5. What if I use the asset 10 years? 10%. What if I use the asset 20 years? 5% per year. Now, once we get the simple percentage per year, then we have to check which method we're using. And if you're using double declining, what do you have to do? Double the percentage. So what will be amortization percentage that we're going to use? 20% time double 40%. Make sense? That's how you're getting the double declining. Getting percentage per year. If it's double declining, double it, and there you go. Can I use triple declining? Let's stay with 5 years. Can I use triple declining? Who's gonna stop me? How much will be the amortization now per year? 60%. Can I use quadruple declining? Declining. Of course. What do you have to do? Just plug 4. How much will be the amortization per year? 80%. Make sense? Okay. So let's stay with double declining now. Once we get the double declining, so now we know how much of amortization we have to take every year. 40%. On what? On the balance. What balance? Now that's the key. So let's start preparing the schedule and we're going to see which balance. First, what we're going to have, amortization. Schedule. What we're going to have, again, we're going to have years. Oh, years was here. Year 0, year 1, year 2, and keep going all the way to year 5. Then we're going to have here beginning balance. Then we're going to have amortization percentage. Then we're going to have amortization for the period. For the period. Then we're going to have total amortization. And then we're going to have ending balance, or that will be our carrying amount. Or carrying cost. And let's start. What's our carrying cost in the year 0? 65. And then we start working. So beginning balance obviously will be 65. How much is our amortization percentage? We already calculated, right? That will be equal to 40%. So how much will be my amortization first year? Hmm. Equal, just a second, equal to this amount. Why is that? Ah, because it's percentage, I need the percentage, that's why. Sorry, a little bit, so then I'm gonna drag this 40%, that because that's gonna stay every period. So the first will be this one time that one. So $26,000 will be my amortization for the first year. Total amortization obviously gonna be 26,000. What will be my carrying balance? 65 minus amortization for the period, 39. 39 become beginning balance, and then keep going. So what do I have to be careful? How much can be my total amortization? Do I know the amount of the total amortization that they have to take? 60,000. Can I take more? No. How much should be my carrying cost at the end of the year 5? 5,000. Can I go below 5,000? No. So on your questions, please don't go below 5,000. So what's the next one? 39. Then I have to calculate this 40%, this one times this one. Basically the same formula like this. Then I'm gonna have my calculation. This one plus current period, total amortization, and the carrying amount is gonna be previous year plus the current period. And then I have the next balance. That's too much. So instead of plus, let's deduct it, right? 23,400. And then keep going, right? Amortization is going to be calculation. This amount is going to be like this, and this amount is going to be like that. So if you let the calculation goes, let me see. That's why we have so many zeros. Five. Okay, in this case, we're okay, correct? Sounds like we're okay. 40% will be that. This one will be this one will be the carrying amount. Carrying amount is going to be this, and then we're going to be okay. Okay, in this scenario, we're okay. Let's do the same thing. And let's use, instead of double declining, let's go with the triple declining. Okay? Let's go with the triple declining now. So instead of having here 40%, my amortization percentage will be 60, correct? So the first year, my carrying amount will be 26, and then I'm going to apply again 60. I'm going to go to 4,000, 10,400. I'm going to apply again 60. And in year 3, where is my carrying balance. Below 5K. Can be below 5K. No. So what do we have to do? Take over calculations. That's where I want you to be. You're taking over the calculations now. And in the year that you're seeing that carrying value dropping below the residual value that you have on the question, you're manually adjusting the amortization for the period that drops you below the carrying amount. So how much should be my adjustment here? How much should be my amortization? Only $5,400. And that's what you're doing. You're manually adjusting on the year that you're seeing that the carrying amount, carrying cost dropping below the residual value, you're manually adjusting the amortization for the period to match your needs. This thing happens only and only when you're using double declining or triple declining. So in order here to work, we have to increase the residual value or we reduce the asset cost. With 40%, I don't know, usually it should work, but in this case, it just didn't work, which is fine. Make sense? Do you understand this thing? And this happened again. This happens only and only on the declining method. Somewhere before the end of the period of the useful life, you're reaching the total amortization or amortizable cost, and you start, if you keep going, if you let the formula, if you let the percentage be calculated based on the formula, you're going to drop below the residual value, which you can. So you have to come and manually adjust the amortization for the period. Do you understand this? All right, so that's with the calculation. Again, I'm going to post you this calculation, this chart, this table, you're going to have it. You can use it for your purposes of the assignments, totally fine. You can try to come up with the same amortization schedule if you want to. At the end of the day, I want you to understand the logic rather than calculating like crazy. Use the artificial intelligence to do the calculation. You tell the artificial intelligence what to do. That's where I want you to be. So let's go with the slides and quickly cover the slides, and I'm going to let you for break. Let's cover this with the calculations. Let me share my screen. Can you guys see my screen? Okay. So again, let's repeat very quickly. First one was straight line method. We're getting the cost minus the residual value divided by number of the years. We're getting the amortization per year. If you need it per year, get it per year. If you need it per month, get it per month. Then you have to do the most difficult accounting journal entry, which is the debit amortization expense, create accumulated amortization. And once we prepare the amortization schedule, the only thing that you have to remember is don't exceed your total amortization cannot exceed the amortizable cost, which is $60,000, and carrying value, the book value or the residual value has to be equal to the asset book value, asset residual cost, carrying cost should be equal to the residual value. If you're using unit production, same idea, get the cost minus the residual value, get how much you have to amortize. Over the kilometers, or the units that you have to amortize it. Get the cost per unit, in this case kilometer, start applying the units that are given. The only thing, don't forget, do your diligence, calculate the number of kilometers, make sure that the kilometers that are actually driven matching the total kilometers that was estimated to be driven. Because on this chart here, we are on the estimations. That's the only thing. And make sure again, total amortization doesn't exceed the amortizable cost, and the carrying value of the asset is not below the residual value. Double declining. On the double declining, first, get the percentage per year, then double it. If you have to triple it, triple it. And start applying it to the balance. So, in this case, what they're doing with the 65, why they differing than our calculation? Where did we make a mistake in our calculation? Did we make a mistake? I wonder, did we make a mistake? Let's go back to our Excel spreadsheet and see if we make a mistake somewhere. On the first, we have 65, we have 39, we have 23, we have 14.40. Let me compare 14.40, 8, that one, and we're applying 30%, 40%. What's the formula here? Yeah. We're below. That's not our problem here. Listen, it's okay if you don't take enough amortization and if you leave the higher amount, that's okay. The question is, don't go below. Here on the question, now I can see they're adjusting it because there's not enough amortization. But you don't have to. In reality, you don't have to go that direction. Just make sure the opposite doesn't happen. If you don't have enough units to complete the amortization to 60, you don't have to worry about it. Just make sure that you don't go over 60. So the question is, which method I should use? Well, depends. Because the straight line method, all the methods going to give you the same amortization at the end. What's the difference? Now, the straight line method is going to give you the same amortization period after period after period. Unit of production is going to match you exactly the usage of the asset. With the double declining, you're going to amortize a lot in the beginning of the life of the asset and less at the end of the life of the asset. So for which unit or for which asset I should use which method? Well, if you have highly sensitive asset, which value declining very fast, use double declining. So if you have computers, if you're dealing with the computers, which their value disappear in the first 1 or 2 years, use double declining method. That's going to match the asset. If you have a steady income from the asset which just depreciate equally, use the straight line method. Let's do this question quickly. What do you think about the answer? Okay, I need another confirmation. Okay, we have the confirmation from two independent resources, so we can say, and Joanna also confirm it, so we're good. D is the answer. Great. Awesome. Do you want to go for a break? Okay, let's take a break then. So now we know how to estimate the cost of the asset. Now we know how to calculate the amortization. Let's see another implication. What will be the amortization for income tax purposes? What if we have half year or partial year? And what we have to revise some of the assumptions, because remember, everything is on the estimations. We estimating the useful life, we estimating of the units that the machine or the asset's gonna produce. We estimating the residual value. What's gonna happen if any of those changes? Let's go with the income tax. Income tax people, income tax, once you go to those of you who are going with accounting, once they reach to the income tax, they're gonna see something very interesting. Income tax people gonna say this. We know that you accountants are very smart. We know that using different methods, straight line, unit of measure, double declining, triple declining, quadruple declining, that's wonderful. Now what we tax people want you to do is whatever you guys doing as an accountant doesn't fly in the Canada Revenue. So whatever amortization expense you already took and you reduce your income. Now we want you to put those amortization expenses back to your income, and we're gonna tell you how much you can deduct for the income tax purposes. So what they're doing is they eliminating the individuality, or they eliminating the differences across Canada, and they specify which method to use and how to use it, and that's directly from the Income Tax Act. The method that we use, it's called capital cost allowance. That's what I want you to know at this point. And for different assets, they grouping the assets into the classes. And for that class, they tell you what kind of percentage to use. Looks like a declining method using that principle on the declining balance, but different percentages for the different type of properties. What's going to happen if we have a partial year? Well, if we have a partial year, go on the monthly basis. Start doing on the monthly basis. If what's the chances you to purchase always the asset on January 1st? Pretty much zero. Why? Because January 1st is not holiday. Nobody purchased. I mean, actually, you can purchase it. You can get a good deal on January 1st. Yes, you can. Why not? But what are the chances you're always going to buy assets on January 1st? Very slim. So what you can do is prorate it based on the months used. So once you calculate the straight line method, or if using the straight line method, instead of year, go down to one period on the month basis, calculate based on the month. What's going to happen, for example, let me show you something on the Excel spreadsheet. What's going to happen, for example, if let's go straight line method, and using the straight line method as an example. So you purchase the asset, but can I use this or can I use something else? You know what? I'm going to use this schedule and this schedule only, and then I'm going to flip to new, completely new worksheet because I need the worksheet the way it is rather than doing so many adjustments. So I wanted to show you something. Let's say we have this example here. What was it? We have it. It's here. Right? You can see the numbers. You cannot now, the sum of the numbers gonna fade. But the whole idea is here is this. You to understand that we're gonna have months, January, February, and then let's put it January, then we're gonna have February, and then we're gonna have March, April, July, October, November, December, right? So if you have to prepare the amortization schedule every month, let's get rid of this. Using our example here with the straight line method, every month we have to amortize $1,000. Make sense? But that's if we purchase the asset in January. So if we purchase the asset in January, so in that case, move it here. Every month we have to amortize 1,000 and keep 1,000 and keep going, keep going, keep going for the whole year. And once we adding all the things, we're gonna have $12,000. Our job is done. We have the amortization for the entire year. And that will be year 1, year 2, year 3, year 4, year 5, because we have it for 5 years. Now, but this if we buy it in January. We say we're not buying in January. Now we're buying it in which month you want to buy it? Give me example. Which month you want me to buy the asset? March. So we don't have a January, February. Now our annual amortization is still $12,000. Make sense? But annual amortization means on every 12 months. So when will be the period for 12 months? From March 1st until February 28 or 29, whatever it is. That will be our 12 months. And that's going to give us $12,000. So when the amortization is going to stop, is it going to stop at the end of the 5th year? What do you think? No. When it's going to stop? At year 6, on February 28. That's why we're going to have 5 years. Because in the first year, we're going to have 10 months. Then we're going to have full year, second year, where we have full second year. Let's put this number, Control C, let's put this number here. And we need those numbers right here. And what's going to happen now? First year will be partial year. Second year will be full year. Third year will be full year. Fourth year, full year. Fifth year, full year. And the last year, sixth year, it's going to get the portion which is missing in the first year. Make sense? And at the end of the day, what's our objective? We to have amortization of $60,000. That's our objective. So now, is it matter which month we're gonna start amortization then? No. The only thing that we have to do is make sure that the months that you're missing in the first year, you add it on the last year. Make sense? If you're missing 5 months, add it at the last year. Make it 260. Can I have a partial month? Why not? Let's say we bought the asset on June 15th. So what are we going to do? Half of the month. June will be half, 500. Where the other 500 is going to go? June in the last year, 500. We're back to 60,000. That's how you're playing with this amortization. Make sense? Do you understand the whole logic? The whole idea is you to have total amortization of $60,000. Is it going to be partial year? Is it going to be partial month? Is it prorated by the day of the month? It doesn't matter. Because if you're losing 3 days in June, you're going to add 3 days on the June on the very last year. And keep going until you get your $60,000. So now on the partial, when you have partial month, usually there's I as an accountant, what I'm usually doing is regardless which day of the month the asset is purchased, I'm not calculating amortization on the month that I purchased the asset. I'm starting my amortization from the next month. That's my rule. That's how I'm doing it in my practice. It's your personal choice. How you gonna do it? It's up to you. What you have to be careful. You have to be careful. What's the size of the asset? What's the size of the company? Because if you're working in the multi-billion-dollar company, every single day calculating amortization or not calculating amortization is going to make a difference. But if you're working in the small company, which you have assets on your both hands, the number of the assets is the fingers on the both hands, or add the hands plus the toys. If you have 15 assets, do you have to worry about when exactly you're going to start amortization? Not so much. That's not going to change the picture dramatically. So adjust yourself once you become a practitioner, adjust yourself to the reality. Once you know the methods, once you know the logic, use the right logic for the right reality. That's my message to you. So let's keep going with the slides. On the partial year, again, example will be company develop policy to compute amortization for the partial year. Now, usually the rules is example is record the full month of the amortization if the asset is bought before on the 50th of the month, or record no amortization if the asset is purchased on the 50th of the month. So basically, you're making trade-off. For some assets, there will be no amortization. For some assets, will be full month amortization. It's up to you. I'm not going to trick you with those type of questions on the exam. There might some of those questions on the assignments, but on the exams, I'm not going to trick you with those questions. And if there's something like that, we're going to talk about it. Now, what's going to happen if we decide to change the useful life of the asset? Well, we have to revise the calculation. So what we're going to see, we're going to get the cost. If we increase the value of the asset, we're going to add the additional cost that we're adding to the cost. We're gonna deduct the accumulated amortization up to this point. If they change in the residual value, we're gonna apply that change. And we're gonna see how many more years left. Do the calculation, see what the number is. That becomes your amortization expense. Move on. If there are questions like this, that will be only on the straight line method amortization. Can I use fully amortized asset? Absolutely. There's nothing wrong with the asset. Let's say you're driving a truck which you want to amortize it. Can you guys hear me? Hello? Okay, so let's say you have the asset which is fully amortized. Can I use it? Yes, you can. But can you add more amortization? No. Let's see what's going to happen if you decide to dispose this asset. Well, you have few options here. First option is to stop using it. In order to record the disposal of the property, there are some rules. First rule is to bring the amortization up to date. Second thing is to remove the asset from the balance sheet. Now you have a contra account which is accumulated amortization, which is related to that asset. Remove that account too. Then calculate if there's gain and loss left. Let's see this one. First option is we use the asset, we amortize the asset, and we stop using the asset completely. We're not selling it, we're not doing anything. So if that happens, amortization should be equal to the cost of the asset. So what you have to do is write off the asset by crediting the asset, write off the accumulated amortization related to that particular asset, and you clean your balance sheet. Second option is what's going to happen if I have the asset which I purchased for $40,000, store fixtures. Somebody come and break it. I haven't amortized the asset, but somebody broke it. That asset is not usable anymore. So I'm going to throw it away. I cannot use it. Once I throw it away, I have to write it off from my books. Let's pretend that up to this point we amortize and transfer from the cost of the asset into the expenses $30,000. We're gonna write off the asset $40,000. We're gonna write the amortization expense or accumulated amortization, which was transferred as amortization expense up to this point. And the remaining amount is gonna be pure loss. Are we losing money in this case? Yes, sounds like a losing money, but we're taking advantage of reducing our income. So yeah, we lost the asset, but we're taking advantage. We're not losing, at least we're not losing the amortization expense. It's still expense, but now coming as a loss on our income statement. Next scenario is when we sell the property, plant, and equipment. Now the thing is, the general rule here is, first, bring the amortization up to date. Second, now I'm gonna change this one because I don't like it the way it is. But I cannot change it because it's already picture. Anyway, second is, get rid of the asset, get rid of the amortization, and naturally see where you are on the journal entry. What do you need? If you need debit, that means loss. If you need credit, that means gain. On what? On the disposal. Let's see one example, and I'm going to explain this through the example. I'm going to grab this example, going to flip it to the Excel spreadsheet, and that's where we're going to do it. Let's do some modification first here to make it a little bit bigger so you can see it. So this is our question. On September 30th, a company sell surplus office furnitures for $50,000. Original cost was $100,000 when they were purchased. The asset was amortized over 10 years on the straight line basis. Annual amortization expense is $10,000. So on September 30th, 2017, they selling it. When they purchase it, can we see that? Can we find out when they purchase it? Yes. Okay. So let's get our information first. Let's start collecting our information. What was the first information that we need? Let's fill this one. Right? Let's fill this information for us. What do we need first? Asset cost. Do we have the cost of the asset? $100,000. Yes. Residual value. Zero. How much we need to amortize? $100,000. Let's keep going with the information. We're using the straight line method. Correct? They're using straight line method. What else we need for the straight line method? We need year of usage. How many years they're using it? 10 years. What's the amortization per year? 100,000 divided by 10. So that will be here 100,000 divided by 10. It's gonna be 10,000. How many months the year has? 12. How much is per month? 10,000 divided by 12. 833.33, correct? So usually in these questions, amortization will be updated to December 31st. When is the year end? So if we have our amortization schedule, what do we have? How many years already passed? Let's quickly get the schedule and let's see if we can easily adjust it to our needs. So what do we need to have? We need to have 10 years, correct? I have to extend it all the way to 10 years. When is the first year? Now we can put the years. 2014, January 2015, and keep going for 10 years, correct? What's our beginning balance? We have to amortize $100,000. What's the amortization per year? $10,000. So that will be equal to that $100,000. Then total amortization, the value 90. Amortization expense per year, still the same, right? Then I can get everything, and I can get this one, and I can get this one. So if I use this asset, that should be my amortization schedule, correct? Where we are right now? We are on year 17. This is our year. This is where we are. We have our amortization up to year 2016. Now the question is, in 2017, do we have a full year? We don't. So this one is incorrect. And since that's where we stop, all this information below is irrelevant. So that's where we are here. Up to this point, we have a carrying value of the asset at $70,000. Accumulated amortization up to this point is $30,000. That's what we want. We know. Now, did we use the asset in 2017? Yes. How many months? 9 months. How much will be our amortization for the 9 months? It's gonna be 9 times amortization per month, correct? And we have it. So first thing what we have to do, we have to record this amortization. That's our first objective. What will be the journal entry? Quickly give me the journal entry. Debit. Which account I'm gonna debit? Amortization. What? Expense. Credit. Accumulated amortization. In this case, furnitures. What's the amount? The amount we already established is 7,500 and 7,500. Our first journal entry is done. Now, how much is my total amortization? 37,500 after you do this entry. What's the carrying value of my asset? 62,500. So, company sell the asset for $50,000. So let's see, we're selling the asset. What we get? Usually we get in cash. Let's get the cash. Debit cash, right? How much cash we get? 50,000. Now the question is, why did they get $50,000? Because they sold the asset, correct? Think logically. I'm getting cash. Why I'm getting cash? Because I'm selling asset. If I sell the asset, do I have the asset? No. Let's get rid of the asset. Credit. What was our asset? Furnitures. Get rid of the asset. What's the original cost of the asset? Hold on a second. Asset stays on the original cost. How much is the carrying amount? That's a different story. The carrying amount is 62 because 100 is the original cost minus 37,500. So the net amount is 62. But once you get rid of the asset, which amount you have to credit it? The original cost. Remember, on the balance sheet, you're going to have furnitures, $100,000, balance sheet, pure balance sheet. Then you're going to have accumulated amortization, furnitures, and that amount will be, let's move this one right here. Accumulated amortization will be negative 37,500, correct? And on the balance sheet, you're going to have net of furnitures, and then it's going to be, that will be the carrying value now, 62,500. Make sense? Do you understand this logic? So if I have to write out the furnitures from my balance sheet, what's the value that's sitting on the balance sheet? On the furniture section, it's $100,000. It's not 65,500. 62,500 is not. The net amount that I'm going to record on the balance sheet is 62,500, but the actual amount that's sitting on the account furnitures is $100,000. Make sense? Do you understand this? Okay, let's get rid of the furnitures. $100,000 gone. Now, furnitures are gone. What else gone? Can I keep the amortization, accumulated amortization account? No, I have to get rid of it. Now the furnitures have debit balance. By crediting $100,000, I'm closing the furnitures. Accumulated amortization furnitures. What's normal balance on that account? Since it's a contra account to the asset account, normal balance will be credit. So how can I close it? By debiting. Let's get rid of it. Debit, amortization, accumulated amortization, sorry, accumulated amortization, furnitures. How much I have to get rid? 37,500. What's the last thing that I have to figure out? Where is my debit? Where is my credit? Am I short on the debit side? Am I short on the credit side? On which side I'm short now? Short on debit. How much I'm short on debit? This one minus this one minus this one. 12,500. What's the 12,500 represents to me now? Loss. Loss on what? Why I'm losing money? on sale of furnitures. Make sense? Always make it logical. Go step by step. Yes, we're using this amortization schedule. Yes, we know what's the carrying amount, but the carrying amount shows us what's the net amount of the asset, which is shown on the balance sheet. Don't forget, original cost is the one that's sitting on the actual account. Is the original cost is the one that have to be taken out. Once you get rid of the asset, get rid of the accumulated amortization for the same asset. Net amount between those two is going to give you the carrying amount on the amortization schedule. Get the cash, solve it for the loss or gain, and you're done. What if we, so watch this. What if with the same entry, Control C, Control V, what if we get $70,000 cash? Where we are now. I'm still not in balance. But on which side now? On the credit side. What's that gonna be for me? Gain. Credit will be gain on what? Why I'm getting on sale on the furnitures. Thank you. Make sense? Make it logical. Don't spend too much time. Make it logical. Just follow the transactions. Following what happened. Get the one that you easily can get. Cash always gonna be given. See how much cash you get. Furnitures. Get rid of the original cost. Accumulated amortization. Well, see where you are, update it for the last year until you sell it. Get rid of the amortization. And after that, do the simple calculation. Where you short on the debit side, if you short on the debit side, loss. If you short on the credit side, gain. And that's it. Questions?